The Federal Reserve is basically America's central bank. But it's not your typical bank. You can't open an account there or get a loan. Its real job is to control inflation, manage unemployment, and keep the financial system stable. Think of the Fed as the referee of the US economy. It doesn't play the game, but it blows the whistle when things get messy. Here's where it gets weird. The Federal Reserve isn't exactly part of the government. It's this strange mix. It serves public goals but has a private structure. So yeah, it sounds a little sketchy, and you're not wrong to think so. But how does the Fed actually control the economy? It has three main tools. First, interest rates. When the Fed raises rates, borrowing money becomes more expensive, which slows down the economy. When it lowers rates, borrowing gets cheaper, encouraging people and businesses to spend and invest more. Second, open market operations. This is just a fancy way of saying the Fed buys and sells government bonds. When it buys bonds, it pumps money into the banks, which leads to more lending and spending. When it sells bonds, it pulls money out of the system, tightening things up. Third, reserve requirements. This one's used less often nowadays, but it refers to how much money banks are required to keep in reserve. If the Fed raises this requirement, banks can lend out less money. If it lowers it, they can lend out more. This is how the Fed prints money without actually printing it. Remember hearing about quantitative easing? That's what this is. But here's the wildest part. The Fed can create money out of thin air. It buys assets like government bonds from banks and credits their accounts with money that didn't exist before. Just like that, new dollars are born, digitally, not physically. Of course, pumping too much money into the economy can cause inflation. That's why the Fed constantly has to balance helping the economy grow without making prices spiral out of control. You saw this play out in 2020 when the Fed injected trillions of dollars to keep the economy afloat. It worked, but now we're dealing with the aftermath: high inflation, rising interest rates, and a lot of economic uncertainty. So who's making these big decisions? The Federal Reserve is run by the Board of Governors, 7 people appointed by the President. Then there's the Federal Open Market Committee, the group that meets 8 times a year to decide interest rates and other policies. Right now, Jerome Powell is the chair of the Fed, making him one of the most powerful unelected people in the country. The Fed is supposed to operate independently from politics, but let's be real, political pressure is always lurking in the background. Why should you care? Because every move the Fed makes affects your life. Interest rates impact your mortgage, your credit cards, your student loans. When they raise rates, your monthly payments go up. When they lower rates, it gets easier to borrow but can also mean higher inflation. It affects jobs, investments, even the price of groceries. So next time you hear, the Fed is raising rates, you'll know it's not just some boring headline. It's a signal that your money, your debt, and your financial future are about to feel it. If you learned something new, leave a comment and tell me. Do you think the Federal Reserve should have this much power? Let's talk about it. And if you want more videos breaking down money and the economy in simple terms, hit that subscribe button. See you next time.